We've all felt that desperation, that moment where you think, if there is any justice, let them see what they've done. If you know that feeling, if you've ever waited for a justice that felt like it would never come, then you need to hear this story. This isn't a tale of revenge from a person, but from reality itself. It's no secret that history repeats. In the stock market, investors perform mental gymnastics to convince themselves. This time it's different. Legendary investor Sir John Templeton called those the 4 most expensive words in the English language. He was right. Nothing empties a brokerage account faster than blind optimism dressed up as financial genius. This brings us to Jesse Livermore, a pioneer of speculative trading, who famously said, "There's nothing new in Wall Street. Whatever happens today has happened before and will happen again." There's a forgotten bubble that proves his point. A bubble that looks disturbingly similar to today. Not the dot-com crash or 2008. A bubble where the market crashed 50%, giants lost 80% of their value, inflation surged from 3% to 11%, and recovery took 8 long years. I'm talking about the Nifty 50 bubble of the early 1970s. The story starts in the late 1960s. America was on a 20-year economic sugar high after World War II. Factories boomed. Suburbs popped up, like acne on a teenager. The nation felt invincible. It had won the war, landed on the moon, and invented the Etch-a-Sketch. Life was good. And in the middle of this optimism was the stock market, up over 350% from 1945 to 1970. This bull run birthed a new strategy, investing in one-decision stocks. The concept was simple. Buy companies so powerful and dominant that you only ever had one decision to make. By these stocks became the Nifty 50. They weren't speculative gambles. They were blue-chip household names. Coca-Cola, American Express, McDonald's. Investors saw them as bulletproof. The idea of ever selling was considered crazy. Here's the thing about investing. If something sounds like a no-brainer with zero downside, it's almost always a financial grenade with a pin already pulled. By the early 1970s, the Nifty 50 weren't just expensive. They were priced as if gravity didn't apply. The average market PE ratio was a humble 15. But the Nifty 50, Coca-Cola traded at 46 times earnings, Xerox at 49, McDonald's at 86, Polaroid at a staggering 90. On average, they traded at a jaw-dropping 42 times earnings. At the peak, these 50 stocks made up roughly 45% of the entire US stock market. With every dollar invested, the market was betting these companies would grow into their ridiculous valuations. Then came 1973 to 1974. Reality slapped everyone across the face. Oil prices quadrupled. Inflation jumped over 11%. Unemployment doubled. Nixon ended the gold standard. The dominoes fell. The stock market plunged 50% in 2 years, the worst bear market since the Great Depression. And when the economy falls apart, overpriced stocks don't correct, they get obliterated. Coca-Cola fell over 60%, McDonald's over 70%. Polaroid collapsed more than 90%. The one-decision stocks became one big financial obituary. Here was the real gut punch. The damage wasn't quick. This wasn't a V-shaped recovery. It took the market 8 years, until 1981, just to crawl back to its pre-crash level. Investors who bought eternal growth stocks were trapped in financial purgatory for a decade. Now, if you look at today's market and feel déjà vu, you're not alone. As Mark Twain said, history doesn't repeat, but it rhymes. In 1972, the Nifty 50 made up 45% of the market. Today, the movie has the same plot with shinier effects. The Magnificent Seven tech giants, Microsoft, Apple, Google, Amazon, Meta, Tesla, and Nvidia make up about 36% of the entire S&P 500. 7 companies carry the weight of the market. Yes, they are innovative and dominate their industries. But so did Xerox. So did Polaroid. They have become the modern echo of the one-decision stock. And their valuations, they, too, are priced like gravity as a suggestion. Google and Meta trade at 28 times earnings. Amazon at 35, Apple at 37, Microsoft at 38, Nvidia at 50, Tesla at a breathtaking 247 times earnings. Are they solid companies? Absolutely. Are they overpriced, overweighted, and worshipped as if they're bulletproof? Also, yes. Just like in 1972, investors are telling themselves the same bedtime story. These companies are untouchable and will grow forever. All we're missing is a couple of macroeconomic dominoes to fall. Warren Buffett summed it up. What we learn from history is that people do want to learn from history. So here we are again, staring at a top-heavy market, pretending valuations don't matter, and whispering the 4 most expensive words in the English language. This time it's different. If this story resonated with you, please subscribe. Thank you for listening. Until next time.